Lauren Goodwin, pleasure to have you on the podcast. Really excited. I'm going to link your bio in the notes for everybody to see, but I want to make sure that I'm giving you the credit that you deserve. Lauren is an economist and director of portfolio strategy at New York Life Investments. Almost $10 billion of AUM between the different strategies that you are listed on. You've been pretty much everywhere. JP Morgan, Wells Fargo, Frontier Strategy Group. You're a CFA charter holder, USC, and Johns Hopkins. Am I missing anything? Anything you care to add?
You are not, although I hope that your audience won't at me for being a big Trojan football fan. It's a polemic thing to be.
My dad went to UCLA, so I will try to hold my tongue. We will move from there. I'm really excited to have an economist on the podcast, and especially you. I mean, I've seen you on Bloomberg and CNBC and all these big time publications, but I think it's a timely conversation to be having with an economist, because so often you hear these super short-term calls on financial media that a hedge fund manager or a portfolio manager makes about a certain stock over the next 3 to 6 months. And I think it's important every now and again, more than every now and again, to zoom out and ask these questions that have a longer term answer to them. Economics is also one of my first passions. That was the reason I got involved in finance to begin with, the economics courses that I took all the way back in high school. But I want to talk about a number of topics. We're going to talk about inflation. We're going to talk about interest rates. We're going to talk about unemployment, federal debt, all of these exciting topics. Admittedly, I had a little bit of trouble putting together the agenda, the conversation agenda, because all of these things are so dramatically intertwined. It's difficult to create a flow chart, a natural progression. I'm going to do my best. I'm going to try to give you as much opportunity to just sound off. You're the expert here, but does that sound okay?
It sounds great.
How about we start with inflation? I mean, I'll set the stage. We had a September CPI read of 5.4% year over year. That's a level that we haven't seen since 2008. If we look at anything from commodities prices to input materials, it's true that inflation is here right now. We're going to talk about transitory versus sticky in a little bit, but I've just listed some of the symptoms. I'd love for you to dive into some of those core causes of the inflation that we're seeing.
Sure. And wow, you want to talk about interlinked items and long-term items. We're digging right into it right away. Thank you, first of all, Jordan, for having me. This is something I've been really looking forward to and look forward to the discussion. What is causing inflation? A lot of things, but when I think about what's most interesting about the ongoing inflation debate, I think about two in particular, maybe a third sort of asterisk comment. The first is supply chains, and I'm sure we've all heard a lot about it. But one of the interesting aspects of supply-demand imbalances that have come as a result of this pandemic is that it turns out we actually don't have quite as much of a supply challenge as seems to be pervasive in conversations around inflation right now. We just have really, really, really strong demand. And one thing that I think is really interesting about that particular supply-demand imbalance is, first of all, it's fairly normal in an economic cycle for production to slow down when the economy does. And then as production picks back up, it gets outstripped a little bit by demand. That's what we see happening. But for me, this sort of supply chain drama is much more interlinked and intertwined with business activity and much more complicated than investors often are able to spend time on. And so for me, when I think about that supply demand imbalance and how it is absolutely contributing to higher prices right now, it's also important to think about, if those supply demand imbalances persist, I don't know if price pressures are going to be the manifestation of that dynamic. We might actually see a complete change in the way that companies invest, the way that they operate their logistics, where they do that, and the way that we as consumers consume. We've already seen it during the pandemic. It wouldn't surprise me if we saw it again. And then the other potential cause of inflation, or what would, I think, contribute to more persistent inflation, has to do with the labor. Same dynamic, less supply, relative to more demand for labor. And we may be in a moment where labor is finally having a period of bargaining power after 10 years of sluggish wage growth. And here again, I'm not sure if we do have this dynamic for a long period of time, if consistent wage pressure is the risk as much as increased automation. And we know that, displaced workers and increased productivity of workers that are working has really big economic implications. So a little bit long-winded, but those are the two real sort of drivers of this debate on inflation. And then my very brief asterisk comment is that we're seeing a lot of idiosyncratic factors contribute as well. The wind stops blowing in the UK, and there's a drought in Brazil. And I do think that these risks aren't as random as they seem. I think that there have been these random risks all along. It's just that the existing sort of inflationary pressures are making them more obvious. And so put that all together, and Jordan, you have a really complex inflation story.
I love the answer. I mean, complex, you're hitting the nail on the head. When you're looking at some of these numbers, it's kind of a function of just how not only investors, but as people, we like to think about things. We like to think of things as a binary, easily answered question, but it really is this perfect storm. Every data input and metric that I look at partially explains the inflation story, but as you just said, it's this complex, almost perfect storm. Wind stopping, blowing, coupled with a cold winter, coupled with supply chain issues for other forms of, if we're talking about natural gas, for example, other alternative energy sources, it's really fascinating to look at. And the labor question is also, I like the answer that you gave, coupling automation with bargaining power that wage earners finally have. Maybe a short-term, intermediate-term, long-term inflation story there, where in the short term, there's wage pressure because people won't go back to work unless they're earning $25 an hour, whatever it may be. But over the more intermediate term, automation kind of takes those jobs back and reduces that wage pressure. And we could be looking at this shorter term, dare I say, transitory inflationary pressure on wages, but longer term automation that increases efficiency. And we know how deflationary efficiency and technology can be. So that's a great answer. I guess now I'll ask the $1 million question, and it seems like you're already touching on it, but for the sake of being binary here, is this inflation transitory? Is it here to stay? Or is it some other answer?
Well, you can't give me an option for another answer if we need to be binary. Yep. I'm an economist. I'll always take the other answer. No, if I needed to pick a team, I would pick team transitory. But here's how I think about it. If you picked me up and covered my eyes and put me down 12 months from now, I think that we'd probably look at the economic environment and say that we didn't have quite as much to worry about as we thought. However, you can't do that. And I think that the next, particularly 6 to 8 months, as the Fed is tapering its asset purchase program, are going to be really uncomfortable for this conversation around inflation and interest rates connected to inflation. And I think it's going to be just a really uncomfortable allocating environment for investors. And frankly, we see a tension playing out between the market and the Fed right now, on where everybody sort of agrees with the transitory story, but they don't agree how we're going to get there. And I think that's the sort of the meat when it comes to investing, because when I look at market pricing and I hear what the Fed is saying, everybody agrees on 3 years from now. But the market is expecting the Fed is going to have to pump the brakes on the economy to get there. And the Fed is saying, oh, maybe these things will resolve on their own. And frankly, it doesn't matter who's right, because the reality is that we're going to have this uncertainty, and we're likely to have some strong inflation prints as of the day we're recording, Jordan. We'll get one tomorrow morning. And we're also likely to have rates volatility in response to that. And so I'm on team transitory, but as an asset allocator, as someone who's working with investments, I'm still paying very close eye to how that higher inflation will impact the market in the near term, because we can't, especially in the face of so much uncertainty, but really anytime, we don't have a crystal ball. We can't be too stubborn with our economic views when it comes to making the right investment decisions.
Do you think that there's part of this problem, though, where there's also just a different definition of the word transitory? If we're comparing the investing public and especially individual investors and the Federal Reserve and Jay Powell?
Yeah, and I think nobody thought we'd need different definitions of transitory, but the Fed has been adjusting as they go, and I think it can be a little frustrating, but I also think it's fair. Transitory probably felt a year ago to all of us to mean, short term, call it 6 to 12 months. And what we're hearing now is that transitory means that it's the nature of this cycle, that it won't persist beyond sort of the unprecedented in so many ways elements of the cycle that we've been going through. And again, here, differences in definition may not matter from an investment perspective. They might be the point, actually, which is to give the Fed flexibility to assess the data as it comes. But again, sitting in an investor's seat, it's been really interesting watching the market narrative develop this year, expecting sort of not having too much trouble with that change in transitory definition. Again, the market's sort of being on board with the idea that these inflationary pressures will eventually fade, but noting how we also did not get a consistent sort of increase in interest rates, or slow and steady as we moved closer to the Fed tapering its asset purchase program. And so that makes sort of a disorderly adjustment or sort of knee-jerk reaction to any more persistent inflationary pressures more likely.
And that's a natural transition. Obviously, policy response to combat inflation is tapering asset purchases and raising interest rates. And we've already gotten the first part of that announced and almost becoming official to the tune of a $15 billion reduction per month in both treasuries and mortgage-backed securities, which puts us at about, I think, June or July of next year before tapering is done. There are a lot of people saying that interest rate hikes, although still gradual, will follow that tapering. Jay Powell's come out and said they're two completely separate issues. We're not going to say it's one and then the other. They're judged on different merit. What does that timeline sound like to you? I mean, do you agree? Do you have a completely different take?
Well, the market doesn't agree. And I think that that's interesting. The market is pricing the first rate hike in June of next year. So immediately on the tails of tapering, actually, maybe even expecting tapering to have to accelerate. And what the Fed is saying is, to your point, is that that's not the case. You'd like to think that the Fed knows the most about Fed policy. But again, here, I don't know that it matters so much who is right for the markets, because I do expect that tension to be playing out in interest rate volatility, really in market volatility generally between now and that June or July timeline. Now, what exactly will happen, I think, it does depend enormously on if some of what looks like it could be peaking supply chain and inflationary pressures. If that does end up being the case, then the Fed will be able to sort of stick to that messaging around interest rate hikes or interest rate liftoff being further down the line, or when the labor market developments really merit it. But we don't know. And so as we do get that data, we're expecting, again, more rates and market volatility generally, and we're positioning or thinking about portfolios in a way that lends more flexibility to what is frankly just such a difficult macro call. We all know the fundamental story, but we don't know what the market interpretation or feeling around that story will be as we get new data.
And you're great at these natural transitions, because the next question is, why should investors care? I mean, if we talk about the different probabilities of outcomes, and one of them is interest rates increasing, one of them is interest rates staying fairly stagnant, I guess there could be another camp where interest rates actually decrease, and there are people smart people who do tack on some probability to that, that possible outcome. what does that mean for investors? How does that affect certain types of equities, certain types of fixed income investments, and the economy as a whole? It's a loaded question, so.
Well, let's start with investors, because I think we can think a little more near term and think about how what the Fed is saying really does have a tangible impact in that field. So the risk here for investors is, again, that interest rate volatility, and specifically interest rates moving higher. It's just not the type of environment that we've had for the last 10 or so years. And the investments that have been in favor as a result of lower interest rates and an expectation of continued Fed support of the economy have been that certain types of fixed income and equity securities do well. When interest rates rise or the curve steepens, we'd expect to see, just as an example, shorter duration securities that are, less sensitive to increases in interest rates outperform floating rate securities whose coupons are linked to increases in interest rates. And then also equities that are less sensitive to rises in interest rates, which tend to be value equities, but aren't always, would be the types of asset classes that would outperform. And so that's from an investment perspective, a pretty notable shift from the pre-pandemic, growth and longer duration type of investment thesis to one of shorter duration and value. And so it's a tactical conversation, Jordan, one that we're thinking about, for investors that have some flexibility in the near term. But it is a market change. It is really interesting. Now, if I wanted to get really philosophical and economic and talk about some of the potential longer term impacts,
let's hear it.
What we're talking about here is pretty. The Fed has a reputation, and not this Fed, but generations of Feds, of pulling the punch bowl away from the party and always raising interest rates too soon and causing a slowdown in economic growth sooner than anybody would like, because nobody wants a slowdown in economic growth. If we see the Fed act, whether it's earlier or more aggressively than we expect, that'll prompt market volatility. But it also has an impact on some of those sort of existential supply chain and labor market tensions I was talking about earlier. I think there's a lot of question about, what can the Fed really do about supply demand imbalances, about, the cost of copper or the cost of gas at the pump. And the answer is nothing directly. But a slowdown in economic growth might impact whether some of these transitions we're thinking about and talking about happen and how they happen. And so if I think about some of the really multi-generational, multi-decade trends around growth and inflation, things like demographics, supply chains, and globalization, around income inequality, this Fed decision is right in the middle of all of those. And so it's a great time to be a nerdy economist, because some of these structural issues are seeing potentially meaningful changes or not. And the way that those tectonic plates are shifting, we don't know how they'll settle. And so I think that while it can feel tactical and feel very short term, the types of things that the Fed is weighing here have long term and important ramifications.
Yeah. I feel like after every answer that you give, I say the same thing. You make a really good point. You're saying a lot of really interesting things. And I love how you keep returning to this idea of focusing on long-term trends. It's something that as professional investment managers, we try to instill in our clients, but it almost feels silly sometimes when we're sitting here talking about what the 10-year Treasury is going to do over the course of the next 3, 6, 9, even 12 months. If anybody looks at a chart of what a 10-year Treasury has yielded over the past several decades, you're going to see nothing but a downward sloping line. And if you really zoom in, yes, you're going to see that we're talking about a very small, relatively it's large because we're coming off of zero interest rate yields essentially. But the long-term trends are these super important key metrics to focus on. And I think not enough people are focusing on them like you are. And these different, I hear so many times the Fed should have no say in things like climate change policy. And I agree the Fed probably shouldn't be making policy decisions as it relates to climate change, but what you're talking about, these long-term demographic shifts, things like income inequality and climate change, I don't think the Fed has any business talking about those as far as them being social issues. But if you think that there aren't long-term policy decisions that need to be made in relation to those things, I'm sorry, but you're wrong. I mean, I'll argue with you on that one. That's there are huge implications down the road. So I'm glad that you are focusing more on these things. Dare I get into the federal debt discussion, because this one gets incendiary. I know plenty of people who, it's easy to chalk inflation up to, passing another infrastructure bill or loose federal spending, that sort of thing. But let's dig into, and I'll set the stage. I'm gonna give some of the boring metrics here so that you can really just get into your take on the situation. But if we're looking at almost $29 trillion in federal debt, a good portion of that between 22 and 23, and feel free to jump in and correct me on any of this, but between 22 and 23 trillion of that being public debt that's interest bearing, we're going to pay or have paid year to date about $400 billion just in interest on that outstanding federal debt. I'm going to give you the big open-ended question here. Have the wheels completely come off the wagon? I mean, is this a runaway train, this debt situation that we're looking at, just as far as the interest that we need to pay and the proportion of our federal budget on an annual basis that those interest charges represent?
Whew, okay, big question. I'm going to give you 3 angles to the answer, all of which lead to, if I'm just going to answer your question, the answer is no.
Okay.
But that doesn't mean it can't. Okay, so three angles to this question. The first has to do with sort of the nature of government spending. And look, there's no way around it. Current debt levels are about as high as those after World War II, and we haven't had a war or a major world war in that sense. And so with debt levels going up from here, it's a valid question. And I think that as citizens or as spectators of what's happening for the US, we should have our eyes on this. But it doesn't, this sort of debt and deficit challenge doesn't necessarily have to bode poorly for the US economy. I think it's tempting to think about the government in similar terms that we do household balance sheets. We have income and we have bills to pay, and those should match, maybe not every day, but on some reasonable time horizon, or eventually that will cause problems. But the fact of the matter is the government isn't a household. It doesn't have the same supply and demand constraints. And in fact, investors all over the world are clamoring to lend the US money at historically low interest rates. So that's one of the other sort of buckets of conversation, is this global demand for US debt. And so instead of thinking about the US government borrowing like household borrowing, we should think about it, and investors do think about it, more similar to corporate borrowing, where the government should, just like any company, invest in projects that generate a positive return on their investment. Anyone who's been to business school or who runs a business knows that if an investment project is break even, so the amount of investment you get about matches the revenue or the incremental revenue you'll get from it, then a company should still invest as long as it keeps labor and capital employed. That just the sheer nature of keeping sort of these factors of productivity moving is a positive thing for the economy. And so the trade-offs that the government has are similar. It makes sense to invest in projects that will contribute to longer term growth and productivity, things like education and infrastructure and technological advancement. And it doesn't make sense to invest in things that create little or no return. So it's reasonable to be concerned about excessive government spending, but we have to, just as economists, investors, spectators, caveat that concern with an understanding that the investment return the government gets from that spending also matters. So moving into sort of the second factor here, until investors believe, and I mean global investors, anybody that would be buying US debt, until investors believe that the government is investing in wildly unproductive projects which regardless of your politics isn't yet the case, including the past couple administrations, then we don't need to be concerned about this from an investment perspective. But that doesn't mean that higher debt and spending doesn't have an investment implication or economic impacts. They absolutely do, and related to economic growth and productivity and taxes. But these are more normal investment themes to assess, not something that keeps me up at night. So that's sort of bucket one, the spiel about how we should think about government debt and deficits in this way. Now I'll get to that caveat around, as long as investors believe that the US is spending on things that make sense and can sort of keep the ball rolling. What we see from, frankly, mostly emerging markets, but we have plenty of historical evidence of developed markets as well, is that credibility, it takes a really long time to deplete it once it's built. When you're the global world economic power, it takes a really long time for investors to get really concerned. But when they do, it happens all at once. And so the challenge here is that we probably as investors wouldn't have a lot of warning signs as to when government debt and deficits would be a problem. It would be a slow build, the frog in the boiling pot, until one day it's a problem. I do think that we're quite a ways away from that problem. And part of the reason for that is the nature of, the spending in the past couple of years has been, shared, both in terms of pandemic spending and in terms of climate investment. And again, from a global investor's perspective, these are considered to be constructive investments, needed investments. And so demand, and this is the third bucket of these securities, is really high. And the US government is one of the only developed country governments that is issuing debt that has a positive interest rate at all. And so I expect demand for these securities for asset liability matching and for yield purchases to remain really high. And as more and more investors in the world age, as societies age, that means more savings. And it's going to mean that debt has consistent demand. And so that's a lot of economic wonkiness and a lot of sort of business decision making, but it's a way of saying that debt's really important. We should always be looking at it, and we should be careful not to be complacent. But I don't see it as a meaningful risk for the economy as long as those projects are financed with an eye towards long-term economic growth.
And I would completely agree that even over the course of the next decade, that this isn't necessarily anything that should keep us up at night. And plenty of the listeners on this podcast, if we're talking 10-year time horizons, they don't necessarily care what happens after that 10-year period. They're going to be well into retirement at that point. But I'm a pretty young person, and something that might not be a risk in the next 10 years could still be an existential crisis 20, 30, 40 years down the road. Is there any, and I've looked at this a bunch of different ways, is there any way that we as the United States federal government can reduce the amount of outstanding debt that we have? Because my answer right now is I don't see any way that we can.
It's a good question. It's a fair question. I also don't see how it gets done without something that, an event or an action that might be more harmful to the economy. So I think, for example, we know what austerity looks like when governments impose major cuts to social spending and increases in taxes and reduction in government programs in order to shore up their balance sheets. That sort of austerity mentality, we now know, has a large part to play in sluggish growth all over the European continent over the last decade. So we have a sense of how productive that is. for reducing debt, which is, not very, and how unproductive it can be for the economy. The only other way is to inflate out of it. And as we've been discussing, we don't necessarily expect runaway inflation to cause the solve the $30 trillion problem when it comes to debt. And so I think that a high debt and deficit level are likely to be a structural factor of developed economies globally. And again, I think that there's a lot of factors not just related to the US, but related to global savings that contribute to that type of environment. Now, I will just say, because one of the things we've been spending a lot of time with our clients on lately is geopolitical risk, US-China tensions, and really any number of things. If I think about a risk that might be, let's call it 20 or 30 years down the line, as opposed to, 2 or 3 years down the line, we speak about these very similarly to the way we speak about those geopolitical risks or long tail risks, which is that they're very difficult to see coming. They have a very low likelihood, but if they did happen, and in this case, it would be sort of a disruptive US debt event, they'd be catastrophic for us as investors, for the global economy. And the way that we think about those types of risks as investors for an investment allocation is it's a two-pronged approach. On one hand, in the near term, it doesn't impact our asset allocation much, if at all, because again, if you're positioning your portfolio for a risk that you think is really unlikely, then you might be underperforming relative to your long-term financial goals that you need to meet. And so we try to keep that focus on, what is the base case world that we see for today and for the investable future, and allocate accordingly. Which means usually there aren't a lot of changes related to risks like this. But then the other prong of that approach is to think about, are there, if an investor does have, a high conviction idea or something that is really interesting in a world in which, the US position in the global economy is changing, then there is a world in which a small allocation to themes like that can be interesting. It can be something that an investor makes them feel engaged and contributes to a sense of stability in the event of a risk like that. And so if you think really long-term sort of cataclysmic type of risks, there's different instruments that could be interesting. It could be something really practical, like infrastructure investing, if that's where you expect a lot of the debt and spending to be coming from, or it can be diversified, something like blockchain-based technologies or cryptocurrencies. And so again, not an element of a core or even a full satellite allocation, but just a two-pronged approach to think about some of those longer dated, more extreme risks.
To anybody listening, I swear, Lauren brought up cryptos on her own. I didn't put her up to it. So I just want to come back and circle back, talking about the federal debt. I think this is a really good way to tie all of the different topics that we've talked about back together. Do you think the level of federal debt that we have, the interest that we're currently paying on it, is that influencing, or does that influence the Fed's willingness to potentially raise rates as a way to combat inflation? I mean, we know that the federal debt isn't denominated in overnight lending like the Fed has control over, but there's a correlation between the short end of the curve and the long end of the curve. If the Fed were to raise rates, you can bet that the 10-year, and let's say the average duration on the federal debt right now is 5 or 6 years, is that relationship factoring into the Fed's decision? Does that, in your opinion, make them less likely to raise rates to combat inflation and potentially give rise to inflation that is here to stay for longer than just transitory?
I don't think so. I really don't. I think that it's very tempting logic, and I think it makes a lot of sense. And the Fed is no doubt aware of those relationships, but I don't think that they're paying close attention to that particular dynamic for two reasons. One is that the dual mandate that they have related to price stability and full employment it's tricky enough as it is. And I think that balancing right now, where we have a hot sort of inflation environment, but a labor market that's full of slack, that dynamic in itself is very complicated and complex. And the Fed's instruments are blunt ones. And so I think that it is really focused on how it manages those instruments for those economic goals and not with respect to the debt. But if that isn't very convincing to a listener, I would completely understand, because it's one of opinion more than anything, because we don't really know. But the other element or reason why I feel confident that the Fed isn't taking this too much into consideration is that there's, just as the link between the Fed's interest rate policy and the government's debt service are connected, and in some ways directly, right? Because whatever the Treasury is issuing is contributing to the bond market and what those yields will look like in the public market. It's connected in all sorts of other ways. The Fed's policy has impact on currencies. It has impacts on other central banks' decision making. It has impacts on the way that companies do business, because it makes imports or exports relatively more or less expensive if currencies appreciate or depreciate. There are all kinds of ways that this interest rate policy loops through the economy and touches government debt, or the price that investors pay for government debt, or the yield on that government debt. And so the Fed's 25 basis point rate hike does not mean a 25 basis point increase on government debt service. There are so many other factors contributing to those rates. And the Fed, I think, is acutely aware of that as well. And so can't even really dream of controlling the government debt service costs relative to all of these really strong other global factors that are playing in at the same time.
Now, I guess to wrap up, I'm going to leave you with two, I guess I'll call them fun questions that are open-ended. We just came out of a pretty chaotic period for the economy and just for individuals in general. So on one hand, what are you optimistic about over the long term, from an economic investment standpoint? And then B, on a less optimistic note, what keeps you up at night?
A great question. And thank you for throwing out the fun ones. I think actually all of these questions have been really fun. I appreciate you letting me sort of go into hypothetical economics land.
No, I love it. I love it.
What am I excited about? I think it's just such an interesting time to watch whether the factors of production, so being sort of capital and labor, actually create a more sustainable work environment in the US. I don't know necessarily that I think it's the base case, but the combination of reprioritization of our health and what really matters, of working at home, of generational trends that are shifting, and of this supply demand imbalance for labor, I think is making managers and company leadership much more attuned to the way that work could just look a little bit different than would ever have been the case otherwise. There was a survey by one of the major bulge bracket banks just before the pandemic, where something like 95% of CEOs said that they couldn't do their work from home. And then of course, 2 months later, everybody was doing 100% of their work from home. And I don't know, just like nobody knows exactly what those changes will look like and what will stick. But my hope is that more flexibility for workers, for families, maybe not in how much work they do, because that would be way too optimistic thinking for this Europe loving gal in the US labor market, but how they do it, right? And the levers of control they have over how that work gets done is something that could be really interesting for, I think, physical and mental health for the U.S. workforce. And so if optimistic, even if optimistic is too strong of a word, I'm hopeful and think that's very interesting. What
Great.
keeps me up at night is I think that in the many transitions that we're going to see over the next year, from 2 years of COVID sort of grappling to a relatively reopened economy in the US, from public sector support to the private sector, fueling growth moving forward. I also think that the tension between US and China is going to become much more visible. This is a decades long rise to power for China, and great power competition is most certainly going to look different in the 2000s than it did in the 1900s. But I think that the combination of things like, President Trump's policy towards China was very visible, but President Biden's policies towards China don't actually look that much different, right? We've seen competition over certain technologies and how they play out. And we know that the average US citizen feels somewhat antagonistic towards China and vice versa. And so I think we're going to see more tension economically, in particular, but also in some sort of national security issues and cyber issues as well. And the narrative around those changes concerns me. And it's not something, there's no specific risk that I see as being, likely to impact the average investor, but it is a dynamic that I think will impact all of us in the years and decades ahead. And there's always a constructive way to manage problems, but different philosophies and politics and economies mean that those those are likely to come into conflict from time to time. And how that impacts all of us is something that well, it's not keeping me up at night yet, but I am spending a lot of time thinking about it.
You and me both. And now for the listeners who want to hear more from you, you have a podcast that you do on is it a weekly basis or monthly basis that New York Life does?
We do. We have a weekly podcast. It's called Market Matters from New York Life Investments. And it is really, it is meant to dissect one market issue a week. This week we talked about the Fed and sort of the tension between the markets and the Fed, and just give a primer on what's going on in one investment idea. So it's usually a 10-minute listen. You can find it anywhere you find podcasts. Again, that's Market Matters from New York Life Investments. And we take listener questions. So we'd certainly welcome those from anyone who's curious.
I'll make sure to include that in the notes along with plenty of different articles that pertain to what we talk about. But Lauren, thank you so much for joining us today, for taking the time. I really appreciate it. And again, I think we need more economists on TV screens. I mean, we've got all these short-term fund managers who want to say this stock is going this direction in the next 3 months. I think we need more people taking a long-term view like yourself. So I really appreciate your fantastic insights today.
Thank you so much for having me, and thanks to your audience for lending us the time.
All right, you take care, Lauren.